You have to keep quiet about your gold holdings and hide it. You hand over the gold to us. You don't hand over the gold to us, we expropriate you. What way do you own gold? And I would store gold not in the US, but overseas. But even overseas, you see, in Switzerland, we have a trend towards socialism. The socialists essentially run the city of Zurich. Mark, you stupid young boy, buy every day some stocks or buy every day some gold and so forth. Don't put it with a bank on deposit. But I would suggest to hold about 25% of his assets in gold. Some of my friends, they own 80% of the money in gold. Or how many ounces of gold do you need to buy a building? Professionals that went to socialist universities, and they all are Marxists and dangerous for the prosperity of an economy.
Mania investors are chasing assets because they want to get rich quickly. Gold is almost the opposite. I mean, it's not a promise of fast wealth. It's kind of a way to protect purchasing power when the promise is around, everything else gets too aggressive. I guess you can see why the younger generation goes for that AI winner as opposed to looking at something as boring as gold. But central banks haven't been. And when we look over it, because the standard narrative here that there's simply de-dollarizing is something our audience has heard a million times. I mean, we're Kitco, but there is a much more uncomfortable reality. I mean, many major central banks are sitting on massive unacknowledged mark-to-market losses of their own bond portfolios. I guess the question is when institutions that print the currency are technically insolvent by private market standards, I mean, is there accumulation of physical gold less about geopolitical strategy and just a silent hedge against the collapse of their own balance sheets?
You're raising a very important point, because for a commodity that has performed as well as gold, say, when I started to work in 1970, gold was $35 an ounce, and now it's 4,500 whatnot. I mean, it's performed well over the long term, and it's performed very well over the last 12 months, 18 months. And there's no excessive speculation. The inflows into ETFs have just recently picked up, but then with the correction, they've again sold. I mean, considering the performance of gold, silver, and platinum over the last 18 months, there has been remarkably little speculation. I go out to bars at night and people play pool, and they have people that are involved in sports betting and all sorts of investment schemes that are scams or dubious.
Markets celebrated risk while one of the oldest stores of value quietly climbed without public participation. According to Marc Faber, gold's rise without speculative mania may be the signal investors are misreading entirely. If central banks are accumulating while retail chases velocity and leverage, the usual risk-on narrative starts to fracture. Savers should pay attention because institutional hedging tends to appear long before headlines explain why. Next, Marc Faber exposes the one balance sheet contradiction that makes central bank gold buying look defensive, not strategic.
I tell you, you hardly ever hear of anyone buying or selling gold. Hardly ever. They buy, and they're all active in Bitcoins and in Solana and whatnot. But gold and silver and platinum, I tell you, of all the people I know, only maybe 5 are active in precious metals.
Interesting.
I'm not particularly active because I just hold gold, period. I don't sell gold. I've sold some of my gold shares because they had huge run-ups, and I'm of two minds about gold shares. I think if you want to make money, you can make money, a lot of money in gold shares, if you buy them at the right time.
The
But
mining. You're talking about mining assets. Yeah.
yes,
Yeah. Yeah.
yes. But I think the mining stocks are quite inexpensive relative to everything else. But I personally prefer physical under my mattress. Under my mattress.
Any miners you're keeping an eye on? I got to ask you that.
I mean, I have South African gold mines and I have Canadians.
Yeah.
And because I was a director of Ivanhoe, I have still a fairly large position in Ivanhoe. Is not one of my favorite stocks right now, and I have a preference for platinum as a commodity because it's very cheap relative to gold and silver, and silver is relatively cheap compared to gold. But wheat, corn, soybean is even lower relative to gold and everything else, and oil. Since you talked about energy, or we talked about energy before, oil is low compared to gold. I mean, you can establish ratios. 1 ounce of gold, how many buildings does it buy? Or how many ounces of gold do you need to buy a building? I mean, a house. And how many ounces of gold do you need to buy a bushel of wheat? And
Everyone talks about new highs, but almost nobody asks what gold actually buys relative to real assets. Marc Faber notes that valuation becomes more revealing when measured in ounces instead of dollars. If commodities, energy, and productive assets remain historically cheap against gold, the story may not be that gold is expensive, but that everything else has lagged. Portfolio protection isn't only about owning metal, it's understanding relative value before capital rotates. Next, Marc Faber reveals why commodity pricing creates a contradiction. Mainstream inflation narratives cannot explain.
how many ounces of gold do you need to buy silver, and so forth. And so you can establish what is relatively low compared to gold. And I can tell you what is relatively low compared to gold is your work, is a labor cost. And what is relatively low compared to gold are food prices. I mean, wheat, corn, soybeans, sugar, and yes, and rubber.
Yeah. 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 It's an interesting one on the
Almost.
commodity side. I mean,
Yes.
listen, for a serious investor kind of watching this, looking to build out a defensive portfolio today, I mean, you brought up some of those allocations, but I mean, what specific kind of percent of their liquid net worth should be allocated to physical precious metals and, others in that portfolio? It seems like it looks a lot different this year.
I mean, as a rule, I would say, and I mean, it depends on the person because he may have large real estate assets and he may be diversified and so forth. But I would suggest to hold about 25% of his assets in gold. And some of my friends, they own 80% of their money in gold. I think it's very courageous because one feature of gold is that it doesn't really yield. It doesn't provide you with a regular income. I have a bond portfolio as well.
Yeah.
And as you say, in the last few years, it hasn't been doing well, but not as badly as, say, a 30-year bond. When you look at the 30-year bond, its price from the peak in 2020 has almost been cut in half. But you had the dividend. I mean, you had the interest payments every year. So the total return hasn't been that bad.
If this cycle continues another year, income investors may discover yield-protected cash flow, but not purchasing power. What Marc Faber is highlighting is that allocation matters more than conviction during uncertain cycles. Gold's weakness has always been income generation, Yet long-duration bonds exposed a different risk: duration destruction masked by coupon payments. Defensive investors should think in layers instead of all-or-nothing positioning. Next, Marc Faber unravels why the assets considered safest may be carrying the most hidden downside.
And in the last 2 years, I just checked, the return hasn't been negative because the 30 years has gone down a little, but you got the 4% interest.
You're talking about T-bills, and the bond market's obviously very interesting right now. But I got to bring up the counter, because we've frequently, or I've heard you frequently kind of highlight the incompetence of these central planners, right? I mean, I guess the question is if the very people holding gold right now and are kind of hoarding gold right now are the same central bankers who trapped us in this inflation style, does it worry you at all to be on the exact side of the trade as them?
Look, as an investor and as a large asset holder, I was fortunate in life. I wasn't particularly smart, but I was lucky, and I worked hard and with a lot of discipline. I mean, I'm 80 and I work every day because I don't mind working. I think it's better for me to work than to drink the whole day. But my view is that everything is in danger zone. When I grew up in the 50s, my grandmothers and grandparents said you have to save 10% of your income and put it on deposit with a bank. Well, that advice was a disastrous advice over time because of the depreciating currency, the loss of purchasing power of paper money. They should have said, Mark, you stupid young boy, buy every day some stocks or buy every day some gold and so forth, and don't put it with a bank on deposit. But interestingly, nowadays, if I look at the asset allocation of people, the cash position of investors is at one of the lowest points in history.
The most overlooked market signal may be that investors trust cash least precisely when uncertainty is highest. This is where Marc Faber's thesis shifts from asset selection to behavioral risk. Central banks buying gold does not automatically validate gold, but it raises a harder question about what they expect from their own policies. For long-term savers, preserving optionality may matter more than maximizing returns. Next, Marc Faber reveals the contradiction between public confidence messaging and actual institutional positioning.
And it tells me that maybe, and the asset that nobody wants are treasury bonds, long-term treasuries. So it tells me if we go into recession and the recessionary forces are much stronger than what people expect, because if asset prices decline, it may affect consumption meaningfully. And if that happens, maybe cash and bonds is not such a stupid allocation for the next 6 months or 1 year. You understand? It's not a long-term proposition. It's just a strategic opportunity. I want to point out one thing about holding gold. One of the leading philosophers of the 20th century was Wittenberg. And he studied actually with Bertrand Russell at Oxford. And anyway, Wittgenstein, his family was one of the most affluent families in Europe at the time. And they owned, I think, about 250 tons of gold in Switzerland, in a vault. And when Hitler came to power, they found out that the Wittgensteins, they were Austrians, but they had Jewish blood. So Hitler went to the family and said, okay, you want to stay in Austria, you want to keep your steel empire, you hand over the gold to us. You don't hand over the gold to us, we expropriate you of everything and send you to concentration camps or whatnot. You have to keep quiet about your gold holdings and hide it. But you can hide it in, if you have a piece of land like Ted Turner in America, you can dig a hole somewhere, nobody will ever find it.
Yeah, this is actually good because we can, the story brings the whole interview back to the core issue: custody, sovereignty, and whether you truly control your wealth.
Markets keep calling long bonds dead, yet every major recession eventually makes liquidity look intelligent again. Marc Faber's argument suggests that investors are confusing short-term protection with permanent conviction. The deeper point is not whether gold wins or bonds win. It is that ownership structure becomes the real risk when policy stress rises. Wealth preservation starts where accessibility and control begin, not where performance charts end. Next, Marc Faber exposes the one institutional assumption about asset custody that breaks under crisis conditions.
I mean, for investors watching this, to wrap up, what is the lesson on gold confiscation and custody? Is it enough to just own gold, or does where and how you own it matter just as much?
Yes, I think this is a very crucial question. In what way do you own gold? And I would store gold not in the US, but overseas. But even overseas, you see, in Switzerland, we have a trend towards socialism. The socialists essentially run the city of Zurich. If they come one day with an initiative and say, well, we have to expropriate the gold from people because they made unusual large fortunes and so forth, who knows? But I would say this relates to all of your assets. First of all, you can't take your assets to heaven or hell. That is something you have to consider. And as a capitalist, it's always difficult to, in my view, more difficult to distribute your wealth than to earn it. And the other question is about gold. There are companies like von Greyerz. They arrange the storage of gold outside of the banking system, and you can take the gold out in Singapore, or I think Australia and Switzerland and Dubai and so forth. They have depositors in different countries, but outside the banking system. Or I think that, say, in Thailand, with all its disadvantages, the property rights are very well established. I mean, if you have a house, the certificate is watertight. It's unlikely that the government will take it away. But with real estate, the government can impose very high taxes. That is, I am, as people know, I'm so anti-government. And
Yeah.
I'm worried about the people that are in government nowadays are not people who worked, and they regard it as sort of a duty to be then looking after government affairs.
The financial industry sells ownership and custody as the same thing, even though history repeatedly shows they are not. As Marc Faber points out here, the location, legal framework, and accessibility of assets can matter more than the asset itself during stress periods. Most investors diversify products, but rarely diversify jurisdictional exposure. That blind spot becomes visible only when restrictions arrive faster than expected. Next, Marc Faber reveals why institutional confidence in property rights contains a contradiction few investors model.
There are professionals that went to socialist universities, and they all are Marxists and dangerous for the prosperity of an economy. In the 19th century in America, why did people travel to America from Europe, immigrate? The reason was there were opportunities for ordinary people to make money. Jobs were better in America, despite of all the robber baron saga and the nonsense that people talk about. The American entrepreneurs, the robber barons, to build the railroads and the refrigeration cars and the machines and the trains and canals and so forth. Yeah, they made money, but they allowed the cost of living of people to go down. The price level in 1900 was lower than in 1800 because they didn't have central bankers. And most importantly, in America in the 19th century, there were hardly any economists and strategists that were spreading lies.
A little bit different than now.
Markets celebrate growth statistics while ignoring whether prosperity is actually becoming more affordable. This is where Marc Faber's thesis shifts from politics into incentives and capital formation. The uncomfortable question is not whether governments should intervene. It is whether policy increasingly protects asset values over productive expansion. Long-term investors should watch purchasing power and opportunity creation, not headline GDP.